Would you like to know more about the financial statements professionally and its elements? What is capital expenditure and revenue expenditure? Today we will cover all of them here. Be with us till end of the video. Welcome to our channel. This is Milad Akbari from Akbari Education. Today we have the base for you about the financial statements and its element. Of course, we will cover two of them here, the financial position and financial performance, and rest of them will come in series of the videos to the channel. Let's go what we have in the video. The first of all, we will cover the 5 elements which will come from the word clear. C-L-E-A-R. Capital, liability, expense, asset, and revenue. And we will come to two types of expenditure, which is capital expenditure and revenue expenditure. After that, we will cover two financial statements, which is a statement of financial position and statement of performance. Let's go directly to the word. First element is asset. Asset is a resource which a business controls. I have bought this board, and now I'm able to use it or sell it. This is what I'm controlling, have the full control on it. It is due to a past action. What was my past action? Purchasing this board, whether on credit or whether on cash. Now, the purpose of this asset is to generate future economic benefit to the business. How it will be created? I can use this board and I can sell it. By using that, I can record the videos and teach to the student. And by selling that, I suppose I have purchased that for $100 and I'm able to sell it on $150. The $50 will be the gain I am accessing to that, or the profit of the business. So it can generate or help in generation of economic benefit to the business. That's why it's called asset. Asset mainly divided in two parts. We have the current asset and non-current asset. Current asset in simple words, which it is a cash or something which is convertible to cash, but in a short period of time. And that short period of time is mostly called a year or 12 months. This kind of assets, which is called current asset, is easily convertible to cash. And the cash itself is also a current asset. So for example, we can say cash account receivable. I have sold something and he gonna pay me after 1 month. This is within one period, which is a year. That's why it's called account receivable. Inventory is something, suppose I have the computer selling and purchasing business. And when I'm purchasing a computer as my inventory and I want to resell it back, that's also called my current asset, which is convertible to the cash and will be used during the business to be sold. We have the non-current asset as well. That another name given to the non-current assets is fixed asset. Fixed assets are the assets which are used by the business for more than a period, which is 12 months or a year. For the example, we can say the building, vehicles, machine or equipment. These are the items which the useful life is, of course, more than 1 year. We can sell it within 1 year, but the expectation in general is that it will be used up more than a year. Suppose I have our building here can be utilized more than 20 years, even 30 years. Even some of the buildings reach to 100 years, 50 years. That's why their costs will be recorded in the financial position of the company, balance sheet of the company, and will be depreciated during the time we are using that economic resource to generate the income. So we are following the initial definition of the asset, which we will utilize that to generate the benefit, economic benefit to the business, and will depreciate that as expense during the life of that asset which is utilized. The second element is liability or debt. That's the amount we are receiving as a loan. We have two sources of finance before going to debt. One of them is capital. We will come to the next slide to that. One of them is about the liability. Liability is the amount we are receiving as a loan, that is something we need to pay that back. That's a source of finance to the business. Before going on, we have two sources. One is capital, one is liability. These are sources of the finance. These are the areas we are receiving the fund from it. Suppose we have received $1,000 from the loan and $1,000 by the capital. We have collected that. This is the source of finance. We have $2,000 now, and we are spending that on purchasing the asset. So the source of the finance come, and we are now utilizing that to purchase some assets, whether we can have it as a cash or purchase some inventory or purchase some a non-current asset or fixed asset. These two are source of finance. The point we are raising now is the liability. We have some cash from the bank as a loan, and we need to repay that in the future. That's why I have received that cash. This is a past event occurred, past action occurred, and now I have a present obligation that I need to pay that back. But how? That will end up to outflow of economic benefit. How? Suppose I have $2,000 in cash. Now I need to pay that $1,000 back to the bank. That's outflow of economic benefit to the business. The same liability is divided in two categories. One, we have the current liability, and one non-current liability. It's exactly the same. We have the terms we have used for current asset and non-current asset. Current liability, the life is less than 12 months or a year. It means we need to repay that back, or the expectation is to repay that back within the year. And for the non-current liability, the expectation is the obligation need to be paid for the period more than a year. For example, we can say account payable. I have purchased something from a supplier, and after a period of 1 month, I need to pay that. That's something within a year. A bank overdraft. Suppose I have with my bank an agreement that after the balance available, I can withdraw up to $10,000 as additional. That additional amount which I have access in my account is called overdraft. Suppose I have utilized all my balance and I need $5,000. I have received that $5,000 and I need to repay that back as soon as possible. Short-term loans is the same as rest of that, as a current liability to the business. In non-current liability, that's payable after a year or more than a period. Suppose I have received a loan of 30 years for my business, and it is repayable after 30 years or during that period. That's why it's called long-term loan. In advanced level, we will come in next futures on that long-term loans also need to be divided in two categories. The portion which we need to pay within the next 12 months, and the portion which is totally long-term and we need to pay after 12 months. This way we will be with the channel. This is all we covered for the liability. Let's go to the capital, the third element. I told you the capital is the source of finance. That's the owner of the business. He is paying to us, and we will utilize that to purchase some asset or have it as a cash for the liquidity of the business. So in simple words, capital is the amount due to the owner of a business after liabilities have been paid. You remember, we have received a capital of 1,000 and liability of 1,000. They all together come and make the cash or asset of the business for $2,000. Now, suppose that the bank called for $1,000 back. I have paid the $1,000. What's the remaining balance? That's $1,000. And that $1,000 is the amount which is payable to the owner of the business. So after deduction of all the liabilities, the amount which is pending and need to be repayable to the owner of the business is called capital. But remember one thing, it's impossible to stay at what stage that the amount he brought to the business is the same amount up to end of the life of the business. Of course, there will be changes. What change will come to that? The profit generated in the business will be added to the capital of the owner of the business. And maybe there are possibilities for some withdrawals. That withdrawals, of course, will will be drawing from the capital of the business, and it will reduce the amount of the capital available inside the business related to the owner. Mainly, we can distribute the businesses in three parts, which have the one owner, sole proprietor, the partnership, which has more than two, come together with an agreement, and the companies, which are mostly limited companies, can be public and private. Be with the channel, we have the specialized video on them. But why I have come to that? Because the capital will be divided in many categories on that. Suppose in sole proprietorship, we have an owner which have one capital, and all the drawings and profit will affect that. In partnership, we have many partners come together, and they have two accounts. One is capital account, initial amount invested, and one is the current account, which the change will come on the current account. And in companies, they have the share capital and premium. So these things will be studied, but these are all types of capital available within these three categories of the companies. These are all the parts we have covered for the financial position, and we will come to the revenue and income. One thing to be honest about that, income and revenue, if you're gonna go and search to the internet, there will be lots of definitions under US GAAP, under IS and IFRS. But let's have the main idea about the revenue. Revenue is the income or the revenue which is generated by the business over the accounting period. It has the main three categories. It can be from sales of product. I have sold my board. Now I gonna earn something. Or suppose my business is computer. I have purchased a computer for $1,000 and I am reselling that for $1,200. The $1,200 which I received is now my income and revenue to the business. But the revenue can be from other sources as well, such as other incomes, such as the interest received. The interest received is the amount for the amount that I have invested in a bank, or I have deposited in a bank. I am receiving some interest on that. I have gone and invested in another company and they are paying me the dividend. That's also something I am receiving as a profit or as the income to the business. We have the gain on disposal. Suppose this board is not my main business. I have purchased that to use it. But after a time, a customer come to me and said, okay, you have purchased that board for $100. I'm purchased it back from you at $150. That $50 is gain for me if I sell this board on him. Or I utilize some product that's now scrapped, the useful life is done, and I'm reselling that. But there is a gain on that. That gain is something which is remaining for me as the income and will be shown on the statement of performance of the business. Against that revenue we have generated, of course, there will be something which is called expense. That expense is the amount you are utilizing or the resource you are utilizing to generate that income. So, is expenses incurred by a business to enable to make the sales and generate income. I am using some products, some resources such as this board, this marker, and these things I'm utilizing to generate income. That's my expenditures. Expenditure will come in two categories. One is capital expenditure and revenue expenditure. These two will be covered in the next slide. But of course, we can say basically that I have paid the salary of my employee. That's something as a direct expense for running of the business. And we can say that I have utilized this board during the period of time to generate the income. So to go in detail, let's go to the next slide, which is capital expenditure. Capital expenditure will incur and will result in 2 points. The first of all, if you directly, in simple word, if you go and purchase some fixed asset, non-current asset, that's called capital expenditure of the business. So you have $1,000, you gone and purchase a beautiful computer. That computer is the capital expenditure and will go to the financial position of the company. And there is another way also that the capital expenditure will incur, and that way is when you are going and doing some expenditure on asset which increase the earning capacity of that asset. Suppose I have a truck. Let me go with example. I have a truck and I am about to install a freezer on that, and that freezer installation on that truck will increase the earning capacity of that asset, my truck or the one. So that additional expenditure will be called capital expenditure and will be recorded in the financial position of the company. And when you are utilizing that one or that asset, that non-current asset, during the period of time to generate the income, it needs to be depreciated. It needs to be charged to the expense in the statement of position of the company. How that will happen? It's under International Accounting 16, International Accounting Standard 16, which will come in next videos and future videos to this channel. Be with us. Let's go to the revenue expenditure. What is that? Revenue expenditure is, again, the outflow to the resource of the business, but it will incur for two main reasons. One of them is the operating expenditure of the business. What is that? Suppose I'm paying salary of my employee. I'm paying for the electricity charges, for the heating of this room. These are all the expenditure I am incurring to operate the business and earn something against that. This is one type of that. The other type of the expenditure, which is called revenue expenditure, is the expenditure which you are incurring to maintain the capacity of your asset or maintain the running capacity of your asset, earning capacity of that asset. Suppose I had a truck, a van. It's going in the way to the customer, and in the way to the customer it become puncture. That puncture will cause that the earning capacity of that one will decrease and it will stop operation. To bring that situation back to the normal situation, I need to pay some expenditure for that, and that expenditure is revenue expenditure. So it will maintain the existing earning capacity, or it will bring it to the normal situation. That's why it's called revenue expenditure. A point to remember that revenue expenditure will come to the statement of performance of the business. So it will be recorded as a temporary expenditure of the year, and it will be offset against the revenue, and it will end up to the profit or loss of the business. We have called statement of financial position and statement of performance. Let's go in detail. What are they? A statement of financial position will show the position of the company. Another old name which is utilized, or currently under US GAAP it's visible, or for the undergraduate degrees they are using, is the balance sheet name. We can use the balance sheet or statement of financial position for that. A statement of financial position mainly come from three areas. One is the asset, one is the liability, and the capital. These three are the items which come under a statement of financial position of the company. But remember, statement of financial position shows the position of a company at a specific date. What does it mean? Let me explain by example. Suppose you are in the position that I am taking a picture, and that picture will show you your position, currently, now. Statement of financial position is the same. It will take the picture of the business and will say how much balance is available in its bank account, how much balance is available as account receivable, how much is the value of this non-current asset. This is the picture we are taking. That's why we chose a specific date. The name which is written above the financial position of a company is statement of financial position as at 31st December 2021, suppose. So this is the picture at the specific date. That's why it's called as at. But statement of performance of the company is something which is called, again, income statement, statement of profit and loss, even they will join other comprehensive income with that. For the basic, we can call it statement of performance. Statement of performance shows the revenue and expenditure of a company during a period. I will come to what does it mean by during a period. But first of all, it will show the revenue and the expenditure of the company. Revenue is the amount which is generated. Expenditure is the amount you have paid, you have incurred to generate this revenue. And it will end up now to whether the profit or loss to the business. But a point to remember, it is for a period. It shows a period. What does it mean? Let me go by example. Suppose we have a video, a movie. A movie will show you that you have start your trip from New York to the Washington DC. The way the point you have started and how you reach to the Washington DC is the movie. And when you are at Washington DC and you have a picture, that's statement of financial position, which shows you are now in Washington DC. But the movie will show how you start your trip and you reached to the Washington DC. It shows the level of income or the revenue you have. Suppose a company have $1 million income or revenue during the period, but possibilities there only $10,000 is available in its bank account. But that's the revenue shows the amount which is started from zero balance, zero amount, to the $1 million. This statement of performance will show the performance of the company during that period of time for the expense and for the revenue. So the name which is given above that statement will be statement of performance for the period ended 31st December 2021. Let's point out the difference. In a statement of financial position, we call it assets. And for the income statement, we call it for the period ended. This is the difference we can remember. We have some practice questions, which is normal in our videos. Of course, to make it concrete for the mind and do have some practice, we will have examples and practice questions in most of our videos. That will help you to remember the point. But let's abbreviate what we have studied by the word clear. I have pointed out what does it mean by clear. Capital, liability, expense, asset, and revenue. We can mainly divide these two in two parts. For the financial position of the company, the capital, the liability, and asset will come in the statement of SOFP, statement of financial position. The other name which have is the balance sheet. The balance sheet was another name given to that. And in other area, from these 5 elements, 2 of them will come to the income statement, which is revenue and expense, RE. Revenue and expense will come to the statement of performance. Another name given to that was income statement. So remember this definition and explanation. This is the simple of all we have covered. Besides, you need to remember what they all mean. Let's go to some practice questions. The first practice question is, which of the following is an asset? We have already studied what's asset. We have 4 options. Bank deposit account is asset, bank overdraft, bank loan, or proprietor's capital. Which of them? I recommend pause the video, just think about that. After that, come with the answer with yourself. But let's continue and let me tell you the answer. The 3 of them, B, C, and D, are different. 2 of them, B, C is the liability of the business. One of them can be a long-term liability, bank loan, and one of them is bank overdraft, which is current liability. And the D is the capital of the owner of the business. So number A is the amount I have deposit in my deposit account. So that's available as the cash in the bank account, and it's mostly liquid and I can utilize that easily. That's why it's part of asset. and it's specifically the current asset of the business. Let's go to the second question. The second question said, which of the following is an example of an item of revenue expenditure? We have studied what's revenue expenditure and what is capital expenditure. The answers we have: insurance of goods in transit to customer. I have paid the insurance that make or ensure that my product is insured to the way to the customer. It's in transit now to the customer. The three rest is import duties charged on a new non-current asset for the business, delivery and installation cost of new non-current asset, and a new delivery one. Pause the video, think about it, and come back to me. But if we continue, the three of them, B, C, and D, will end up to the purchase of a non-current asset. Remember one point, we will have another video on that, how we will record the capital expenditure and how the cost of non-current asset. It will come in future videos. Be with the channel. But a point to raise is the expenditure which will incur to bring the non-current asset to the point that we can utilize will be add up to the non-current asset cost. And these costs will be recorded in the statement of financial position of the company. Whether we are paying the import duties, whether we are paying for delivery and installation of that non-current asset, or we have purchased that non-current asset, all of them will come to the statement of financial position of the company, and that's why they are capital expenditure. The only point we have is the insurance of goods. This is for the operation of the business. This will end up to generation of income. Suppose if that goods is not reached to the customer, or it has been lost, that's something I'm losing from the business, or that will be the loss to the business. Of course, it will affect the operation of the business, and that will not be counted as a revenue of the company. So insurance of the goods in transit to the customer is a charge I am paying, or the expense I am paying as a revenue expenditure of the company. We have another question as well, which is a bit tricky. Remember, in professional studies, specifically for the certifications, we have the questions which will play with the words. Here, which of them is not a capital expenditure? So when we say not a capital expenditure, you need to focus, not a capital expenditure. The question is not which of them is capital expenditure. We have 4 points: capital, purchase of a new motor van, purchase of a second-hand factory machine, replacement of the managing director's Mercedes car. Pause the video, think of that, and come back to me. Let's continue. 3 of them, B, C, and D, are something we have purchased as a non-current asset of the company. And these items will be recorded in the balance sheet of the company. And the first one is, of course, the capital. And if you remember from initial slides, I told you, capital is the source of finance. You will receive that from the owner, and after you receive the source of finance, then the board of directors will decide what to purchase, or whether have it as a cash. After that, it will start up whether you are going for the revenue expenditure, or for non-current asset, or for whatsoever you are spending that. So up to the point, it is capital, and it is an element of financial statement. Thank you so much. This is all we have covered. We have more similar videos. They will cover the more specific areas, the more professional areas, but very simple word. In very simple word, we will tell you that. So please subscribe our channel, press the notification button to receive the alarm for a notification for the new videos, and remember one point: let's grow up all together. So suggest this channel to your friends, share with them, that they also come and learn something. And my one point: let's grow up all together. This world is much more big and much more enough space that all together grow and live peacefully. Thank you.